Stagflation.
Stagflation scenario.
Stagflation.
There's a lot of chatter right now about the dreaded S word, being stagflation. So in this video, we're going to talk about what is stagflation, what causes stagflation, and why is stagflation and type of economic conditions so dreaded in the first place. But before I get too far into it, don't forget to smash the like button for the YouTube algorithm, subscribe to the channel, ring that notification bell, and let's get into it. So according to the Corporate Finance Institute, there's really three conditions that must prevail in order for an economic climate to be considered stagflationary. 1, there must be a relatively high degree of inflation. 2, there must be typically a high degree of unemployment. And thirdly, there typically must be a contraction in the overarching economic conditions. And these elements together, they sort of make sense, or at least if you take two of them together. So for example, if you're looking at unemployment and unemployment as it relates to GDP, when you have a high level of unemployment, typically that means you're going to have lesser money in people's pockets, due to which they will of course spend less, which will result in contraction when it comes to the economy, which is represented in negative to low GDP growth. Similarly, there is also this inverse relationship between unemployment and inflation. And that really makes sense as well, because typically when you have periods of low unemployment, that means more money in people's pockets. More money in people's pockets means they have the ability to spend more, which typically results in goods and services being priced higher. And when goods and services are priced higher, you typically have inflation as well. At this stage, the US economy really has 2 out of these 3 conditions really prevailing. So for example, based on the last CPI report, everyone knows that inflation is running hot at 9.1%. Similarly, at this stage, everyone knows that the GDP, or the overarching growth in the economy, is slowly but surely coming down quite heavily, and one could even argue that we're experiencing 2 quarters of negative GDP growth, due to which we're arguably already in a recession. The only fact pattern that isn't going on right now is we are in an environment where there is relatively low unemployment. I mean, at the last reading, we were sitting at 3.6% unemployment, and there appears to be 11 plus million jobs that are still available. Now, early on in this video, I did say stagflation is typically a fairly rare type of condition, because the impact of stagflation the last time it occurred in the United States was so severe that at this stage, the Fed has been very much on top of these types of conditions in order to prevent them from occurring. And when I said the Fed has been on top, until arguably quite recently. Last time there was some semblance of stagflationary type of conditions was back in the 1970s and 1980s, and it was largely driven by a variety of different factors, 2 of which were coming down to poor economic policy and of course OPEC sanctions when it came to gas. These conditions were absolutely atrocious for the consumer, because it did result in double-digit inflation, sky-high mortgage rates, and a weak job market with unemployment hitting 7%. Inflationary conditions were so severe back then that the Fed chair at that point in time took some crazy actions where he basically bumped up the Fed funds rate to 20% a couple of times in order to alleviate this amount of pressure when it comes to inflation. Now, there's lots of arguments in terms of, whether this was the right action or whether it resulted in the desired outcome. The fact of the matter does remain that it does appear to have been much needed, because since that point in time, this is the first time where inflation has exceeded 5+%. So then the $1 million question becomes, are we headed towards stagflationary conditions or not? Well, it's hard to specifically say, but what we do know are the following. We do know that the Fed is going to do whatever it takes in order to control inflation. They've already put the Fed funds rate, or the target on the Fed funds rate, to be somewhere between 3.5% and 3.75%. The Fed funds rate is currently sitting somewhere between 1.5% and 1.75%. But you can really imagine, right? We're talking about the Fed funds rate effectively doubling itself from where it is right now. And you're already sensing the economic pressure that is out there. You're experiencing, or we're seeing, mortgage rates go through the roof. We're seeing credit card interest rates start increasing. We're seeing a variety of these things happening in order for this economic growth to basically come down quite significantly, because it's all being done in an effort to control inflation. So if you take the current Fed's funds rate and then basically double it, you can imagine the amount of economic pressure that is going to be occurring when that happens. Lots of companies, particularly in the tech space, particularly in the startup space, have already announced layoffs. Lots of other companies have already announced hiring freezes as well. And as the Fed continues to increase rates, what's typically going to happen is it's going to make the cost of borrowing for a lot of these companies to be very, very high. They're not going to go out and release more equity into the market. They're not going to do that in the form of financing due to the fact that, hey, the stock market's pretty much in the dumps. They're not going to be able to get new loans because they don't want those loans because the interest payment associated with those interest rates is going to be so high. So they're going to reduce their investments when it comes to their own operations. When it comes to reducing those types of costs, you can associate that with, hey, some level of investment, some reduction in the number of people that you have. So you're going to see more and more of an increase from that 3.6% unemployment level to where it may potentially be. So if some of these things do take place, then that third condition, which is the unemployment condition or the rising unemployment condition more specifically, would effectively be in place. And if that is in place, you have all the conditions or the criteria met to be considered in that you are in a stagflationary type of economic environment. So now it's up to you. What do you think? Are we headed towards a stagflationary type of economic environment in the not too distant future? Include all of those thoughts in the comments below. And if you've stayed this far, I hope you enjoyed the contents of this video. Don't forget to like and subscribe, and I'll see you in the next one.